What if crises aren't accidents, but scheduled opportunities for the few? What if fear is a tool and someone owns the manual? Tonight, we open the vault on central bank's secret playbook, the script that turns chaos into profits again and again. The twist, it's been hiding in history, in plain sight. London, 1694. A war-torn monarchy needs cash. Investors get a chartered bank. The Bank of England is born, and a pattern with it. Trade emergency funding for lasting power, then repeat. Centuries later, Walter Bagehot refines the creed. Lend freely, against good collateral, at a penalty rate. Save the system, but don't invite recklessness on paper. Reality, penalties fade when panic hits. Survival trumps discipline. 1907 proves it. J.P. Morgan herds bankers, halts the spiral, and foreshadows the Fed. 1913, the firefighter institutionalized the Federal Reserve. 1929, catastrophe arrives. Gold constraints, bank failures, money contraction, depression deepens. Lesson learned, rules change when stakes are existential. 1944, Bretton Woods links the world to the dollar and gold. The peace holds until deficits and the Triff-in dilemma crack it. 1971, convertibility ends. Money floats. Inflation erupts. Volcker crushed prices with double-digit rates at brutal cost. Inflation breaks, and a new belief takes root. Central banks can decide outcomes and markets believe it. 1987, stocks crash. Greenspan promises liquidity. A new signal forms. There is a floor under risk. 1998, LTCM implodes. A coordinated rescue averts contagion. Cause and effect. Save today, raise risk tomorrow. 2001, easing cushions a tech bust. Housing becomes the sponge. By 2006, leverage blooms. Complexity hides fragility. 2008 rips the mask off. Banks fail. Markets freeze. Fear peaks and the playbook deploys at scale. Zero rates. Trillions in bond buying. Guarantees for the funding pipes. Backstops for money markets. Blessed mergers. Emergency facilities. Extraordinary legal contortions. Losses socialize. Liquidity privatizes. Assets roar back. Within years, the S&P more than doubles. Credit spreads collapse. Who captured the upside? Those closest to the spigot dealers, asset managers, leveraged borrowers. Call it the Cantillon Effect. Modernized and turbocharged. New money enters through markets first. Asset owners benefit first. Savers in cash flag. Inequality climbs. Europe writes its own verse. Mario Draghi. Whatever it takes cements an implicit guarantee. Yields compress. Carry trades proliferate. Risk-taking rationalizes itself. Banks tap TLTROs at negative rates. Then profit parking funds. Japan pushes further QE, ETFs, and yield curve control. A central bank becomes the market. Savers starve. Volatility declines, and a reflex forms. Buy the dip. Normalization attempts falter again and again. 2013 taper tantrum shakes bonds. 2018 balance sheet runoff tightens liquidity. Markets buckle. September 2019 repo rates explode. Funding backstops return. 2020 arrives everything at once. Lockdowns, panic, and stimulus like wartime. USM to jumps over 25% year over year, the fastest since World War II. Stocks rocket. Housing sprints. Speculation goes vertical. Inflation returns with a 40-year vengeance. By 2022, prices rise at the fastest clip since the 1980s. Policy reverses. Rates rise at the swiftest pace in modern memory. Bonds suffer historic losses. Balance sheet strain. March 2023. Regional banks crack. Deposits flee. Unrealized losses surface. A new tool appears. Par funding against underwater bonds, the BTFP. Extend time. Avoid fire sales. Protect confidence. Preserve options. Again, carry trades bloom. Again, insiders harvest spreads. Central banks themselves discover the flip side. Key portfolios yield low, policy rates surge. Remittances turn negative. They pay vast interest on reserves and reverse repos to financial firms. Treasuries lose the dividend. Deficits quietly get a little deeper. The playbook keeps narrating outcomes. Step 1. Stop panic with guarantees and unlimited liquidity. Step 2. Push money out the risk curve by crushing safe yields. Step 3. Stabilize, declare victory, and try to normalize until something breaks. Each cycle transfers power to the center and profits to the edge. Who loses? Latecomers, savers, fixed income retirees, small competitors. Who wins? The leveraged, the informed, the closest to collateral and credit. Look at the numbers hiding in plain sight. The Fed's balance sheet swelled near $9 trillion, the ECB's above 8 trillion euros, the Dow Jones a massive share of JGBs and a slice of equities. Global debt has topped $300 trillion new peaks. Every cycle, U.S. household net worth hit records as markets rebounded, then soared. The top 10% gained share. Cash savers lost purchasing power. Reforms tried to tame this machine. Dodd-Frank, Basel III, stress tests, living wills useful, but incomplete. Too big to fail grew bigger. Shadow banking swelled into tens of trillions. Market plumbing still depends on a few dealers and thin balance sheets. The pattern repeats because incentives repeat. Backstops create confidence. Confidence fuels leverage. Leverage manufactures fragility. When fragility breaks, the backstop returns, resetting the trade. So, what now? 3 takeaways you can use before the next headline hits. Understand the sequence: panic, guarantee, reflate, normalize, break, repeat. Watch the pipes: funding markets, collateral spreads, and forward guidance tone. Position for policy, not just valuation. Risk premia compress near backstops. One warning: the bill arrives differently each time, sometimes via inflation, sometimes via taxes, sometimes via lost opportunity. Open question: can we save systems without supercharging moral hazard? If this helped you see the pattern, subscribe, share, and tell me your next mystery.